Good day. Welcome once again. Welcome. This is Seewing Yee, and nice to see all of you to listen to my another one of my video. All right. So without further ado, let me share with you the screen and the topic in question. And the video topic is how to in 2023 how to build your real estate income property portfolio, how to do asset allocation, and how to do diversification, and what I mean by dollar cost averaging. So before we conclude, please, when you go all the way down to the finish, if you see value in this video, please smash the like button and subscribe to my YouTube channel. I need more subscribers. And finally, you could put your email into our website so you can receive free weekly real estate investing information, which should benefit you immensely. So without further ado, let's proceed. All right, so imagine if you can create a real estate portfolio or income property of single family homes all the way up to duplex, triplex, fourplex. 1 to 4 unit is ideal in this niche investment methodology. So what if you can do it with inflation proof, recession proof, or housing crash proof? Okay, I'm not guaranteeing you anything whatsoever. I mean, no one can predict the future. We don't have a crystal ball. I can only speak in terms of historical perspective. But you can do it, in a way that in the past has been proven to be very, very successful. As myself, I've been helping many real estate investors from all over the country to buy out-of-state, remote, turnkey, cash flow, entry-level, low-price investment homes and place a tenant in those homes for the long-term buy and hold strategy. Right. So let's go to some details. Now we are doing, when I mean diversification, I'm asking you to diversify among geographical regions, because each local market is different, right? There's no such thing as a national real estate market. So there are, real estate market is very hyper local, down to the city, down to the metro, down to the region, down to the neighborhood, down to the block, down to the down to the lot. Okay, that's how local real estate is. So every market reacts differently, right? Because every market have their own unique economic characteristics. So you over time, as you build your real estate portfolio, you buy in different markets. And furthermore, another definition of diversification I have for you is, you can buy single family homes, which is the most attractive type of real estate asset class out there. Single family homes, cookie cutter, 3 bedroom, 2 bath, those types. And or you can buy duplex, triplex, and fourplex. 1 to 4 unit is the ideal, uh, um, house diversification, because I'm not going to spend too much time on it, but 1 to 4 unit, you can get the most favorable Fannie Mae lending guidelines with the lowest possible investor rate and with the best terms and rates, what have you. Okay, so let me sort of and I mentioned the word cost averaging, dollar cost averaging, right? I mean, dollar cost averaging, to most people's definition, let me share my full screen. Dollar cost averaging, people use this term technically and historically in stock market, right, or mutual funds. Dollar cost averaging when, regardless of how the market is swinging, the cyclical nature of the stock market, you every month you buy at a set amount of money, $100 per month, you buying 4 mutual fund shares. The next month, you continue to invest consistently every month, every year. You put a set amount of money in a mutual fund, and based on the up and down fluctuation of the stock market and the mutual funds and on the underlying asset, you can buy more shares or less shares. But over time, if your dollar cost averaging will consistently keep on contributing the money on a monthly, on an annual basis, over time, your dollar cost averaging will yield you a very comfortable portfolio so you can potentially retire on. So risk investing is no different. The property I'm showing you on this example, I think I'm showing you 6 or 7 properties, could be more, could be less. Use the same terminology, dollar cost averaging that you use in a stock market with the mutual funds. You can do the same thing with real estate. So every year, given your financial resources or lack of, some of you can create a 5, 10, 15 property portfolio. Each year, some of you can buy 3 or 4 properties per year. Some of you, because of your limited financial resources, you can buy only 1 per year, right? Or whatever. So the thing is, what if the market is going through a real estate market in an area that you want to buy a particular property, or going through a downturn, or going through a fast rising situation? To you, as a risk investor, as a long-term buy and hold investor, it does not matter. You buy when you're able to buy. There's never a wrong time to buy. You buy based on your research, your due diligence, and then as long as you buy in real estate, in income property, as long as you can cash flow at 20 to 25% down payment, as long as the rent, if you put 20 to 25% down payment, as long as your monthly gross rent pretty much cover all your debt service. Okay, if that's the case, and if it's a good rental market, you can always get renter in there to rent out your house. Yeah, for the most part, 95% occupancy rate, that'll be ideal. 5% vacancy rate on an annual basis on all of your properties, that'll be ideal, optimum portfolio efficiency. So regardless of how the market is going, whether you're going through some recessionary times right now or real estate correction times right now, you can still buy, because the philosophy that I use, and you buy real estate and wait instead of wait to buy real estate. Okay, so therefore, using the power of dollar cost averaging, you buy regardless of the real estate cycle, because you keep on buying and diversify accordingly, geographically speaking, and you diversify among real estate asset class, 1 unit at a single family home, duplex, triplex, fourplex. And you just keep on buying, and eventually, when you establish this massive portfolio of 10, 15, or 20 investment properties in different areas, I mean, you can become recession-proof, inflation-proof, housing crash proof, because you're creating an amazing diversified portfolio. Am I being very clear? I'm trying to just say it in a word, in a layman's terms, so you all can understand. So please, comment below on our comment section. Let me know what you think. Okay, did I explain this correctly? Did I this message out there? You could be a newbie, or you could be an experienced investors. It does not matter. Okay, the way I'm trying to explain to you in layman's terms, I hope you understand. Okay, so I want to put myself in your shoes. I want to know what you're thinking, because I work with newbies over many years also, as well as experienced investors. Okay, let's get back to my slideshow. So this first property, it doesn't matter. I mean, yeah, the properties are low cost entry-level homes, a combination of older homes and a mixture of new constructions. New construction single-family homes typically cost a lot more than resale homes in other markets. So it all depends on what market. I'm just giving you a high-level illustration, okay? I mean, I can't get into the nitty-gritty details, but this is a high-level portfolio architectural design, acquisition strategy and plan. So this first property happened to be a single family home, new construction in Southwest Florida. It's the market price is $359,000. You put 25% down payment, even at the 6.5% mortgage rate, whatever. This is your down payment, and you're getting a rent of $2,600 per month from a renter. Then you collect your rent, or your property manager going to collect rent. You manage your monthly debt service. At the end of the day, you have a positive cash flow of $125 per month net monthly. This is just a starting point. Creating wealth in real estate is beyond your first year numbers. It's beyond this allegedly low cash flow, because there are many ways to make money in real estate, and I'm going to tell you shortly. Okay, so this is your first property, geographical diversification, asset allocation, and dollar cost averaging. So your second property, I'm going to show with you, is in Alabama, for example. Right, it's a new construction in Alabama. 910 square foot, 3-bedroom, 2-bath. It costs only $210,000. So very rare you can find a new construction single family home anywhere in the country for this low price, especially for real estate investors. So this is, by the way, all these are real properties as we speak. They are being presented to our network of investors. Anyway, so your second property, you're going to buy a 25% down payment, 6 or to 6.5%, depending on if you're going to use a 2-to-1 rate buy down, or take advantage of the new builders incentive that you've been getting, luckily, for the short term. So down payment, $52,000. Minus closing costs, total out of pocket, and then you can rent the property out for $1,550. That you manage your monthly debt service, taxes, insurance, property management fee of 10%, and vacancy factor, maintenance factors at 5% appreciation projection. All these are just projections, okay? Anyway, and then you get your 30-year fixed rate mortgage at 6% or 6.5%, whatever, which is $944 monthly. So you add up all your debt service, your monthly expenses, minus from the $1,550 gross rent, equals your net positive cash flow of $246. So at least in cash flow, excuse me. So that's a win, right? As long as you pay cash flow just a little, look, $246. I mean, this cash flow is, is not gonna make or break your financial future. But hey, over time, your rent gonna increase, your tenant gonna pay down your loan, you can get appreciation, you can get tax benefit, I'll discuss more about that. All right, so this is your second property. So you have just diversified first in Florida, Southwest Florida, Cape Coral area. Then your second property is in Mountville, Alabama, which is, I believe, outside Huntsville, Alabama, I think, I'm not sure. Your third property, you're going to buy one of those older resale homes in the Midwest. Midwest markets over many, many years have achieved the highest cash flow for investors. There will be more passive income because the price point is so low in those markets and the rent is high. But you may or may not get the appreciation that you want relative to the other market in other areas of the country. But it still makes sense, right? This single family home is $73,500. You put 25% down payment, and then of course you can collect a rent of $950. At the end of the day, then you get a mortgage for 25% down payment, and at 6.5% or thereabout, and so your monthly rent of $950 minus your monthly mortgage, taxes, insurance, property management fee, vacancy rate of 3%, and maintenance percentage of 5% on an annual basis, you still net a very good positive cash flow of $255. So that's a win, okay? So very good return, very good rent value ratio, very good capitalization rate, the whole 9 yards. Another property happens in the same area in Buffalo, Niagara Falls. This is your fourth property. So this happened to be a fourplex. It's a resale home. It's quite old, but it's been rehab, turnkey, the whole 9 yards. So this fourplex costs a measly $249,000, which is a great value. Completely rehab turnkey, renters in place, all 4 renters. So you collect a rent of total gross monthly rent is $3,500. So 4 divided into 3,500. So you collect around almost $900 per renter out of the quad, out of the fourplex, and minus vacancy factors, minus maintenance costs, vacancy factors, property management fee, minus taxes, insurance, in your monthly mortgage of $1,300 based on a 30-year mortgage, 7.5% mortgage rate. So, by the way, as an investor, it's not about interest rate. But interest rate is part of your debt service, your monthly mortgage. As long as you can get positive cash flow and the yield and the return meets your criteria, meets your expectation, then there's a win. So at the end of the day, your gross rent of $3,515 minus all your monthly expenses and debt service, you're still going to end up with $540 monthly net cash flow. Then you add on the tax benefit, appreciation potential, rental rate increases, loan balance pay down over time. You can get a whole bunch of returns on a year-to-year basis for the long term. So a fourplex is nice asset class diversification above and beyond single family home. So you can scale your portfolio. You get multiple tenants renting one structure. So they'll give you, in case one become vacant or two unit become vacant, you can still collect rent from the other occupied properties. So there you go. And then the fifth, I forgot how many property. The fifth property I have here as an illustration is in Central Texas, outside Austin, 1 hour above Austin, Temple, Texas, to be exact. You're buying a new construction for $320. New construction single family home, very fast growing area outside Austin. And you put 25% down payment, at 6 to 6.5%, maybe even 7%, 30-year fixed rate mortgage, depending on what kind of loan program you do. Investors have a lot of flexibility. So your down payment is 113 grand plus closing costs, 4 grand total out of pocket, almost 120K. You're collecting a rent of $2,200 on a month-to-month basis, annual lease most of the time. Then you pay your monthly tax, the whole debt service that I talked about, and you put in your 30-year mortgage. Your payment is $1,277. So you add up all your monthly expenses and your debt service minus the $2,200 rent, and you still gonna have a positive cash flow monthly of a little bit more than $100. All right, so nice geographic diversification to take advantage of the long-term growth afforded you in the Central Texas mega market. What's that word? Mega region. Of course, I put this slide in here because real estate is the best hedge against inflation. The government rate of inflation, give or take 8% right now. But come on, let's be real. Okay, you go grocery shopping, you go out there, have fun. You're gonna pay this amount more this year than last year. So the unofficial inflation rate is probably 10 to 15% or even more, depending on what type of consumer products or you're buying. So real estate is inflation hedge, to say the least, in addition to other benefits, which I will touch on toward the back end of this video, which is coming very shortly. And the next property you're going to buy, another location in Florida, that's in LaBelle, which is inland, 1 hour inland from the coast, and the path of growth, the suburban growth, the sub-market, and all over Florida, things are happening, right? People are migrating into the suburbs because the inner markets of Florida are getting to be more expensive because Florida is growing so much by leaps and bounds, job growth, population growth, migration, epic migration patterns, the whole 9 yards is going to happen for years to come. So this single family home, brand new single family home located in LaBelle, is $249,000. You collect a rent of $2,200. Very high rent, relatively speaking, based on the purchase price. You minus your monthly debt service and your 25% down mortgage, even at 7%, even at 7%, 30-year fixed rate mortgage, because the rent is high, relatively speaking, you can still cash flow monthly around $319. That's a very nice chunk of cash flow. But then again, all right. So another good, and then that's it. I just, how many properties I mentioned? 6 or 7. I mean, just could be less, could be more. How long is it going to take you to create this portfolio? A year, 2 or 3 years? Yeah, it all depends on each individual situation. Some investors they're more motivated, they're more courageous, they're more ambitious. They can buy more than 7, 8 properties. One more thing, because you're using a turnkey approach, you're using professional property management. I mean, you can maintain this real estate portfolio even if you're working full time at your regular W-2 job. So 10, 15, 20 years later, once you achieve the available passive income, you may be able to replace your job. I don't know. It all depends, right? What's your lifestyle? But needless to say, rental property is a history's most powerful and proven multi-dimensional real estate asset class. It's the world's greatest wealth building investment vehicle because it pays you many different ways other than cash flow. Your cash flow, even though initially may not be that high, you can always refinance your loan. All right, in the next couple of years, right now, the interest rate on a mortgage could be 6 or 7%, depending on the kind of loan program you're gonna get. So you marry the house, you date the interest rate. So you can always refinance when the interest rate falls down to 5.5% or 5%. Then your cash flow will increase accordingly once you're able to do that. Because owning a rental property, you have so much negotiation power, you have so much flexibility, right? And so that's one of the multi-dimensional way you can make money is cash flow. Continue rental income growth. You can increase your rent or even on an annual basis, depends. If the rent growth coincide with the inflation growth rate every year. So expect your cash flow to increase more and more over time. And then, of course, tax benefits, right? I'm not going to talk about that too much because it'll take a long time to talk about tax benefit. Suffice to say, you get passive losses, depreciation, cost segregation, real estate professional tax status. You can cash out, refinance tax-free on the equity of your portfolio down the road. You can sell your current rental properties and using a 1031 tax deferred exchange and not pay your capital gains tax. You can leverage and upgrade your portfolio into commercial units or whatever, what other asset class you want to buy down the road. And of course, real estate will give you historically an appreciation. If you buy in the whole 10 years or more, your property going to increase in value, although some of you may question that based on current short-term correction status that we're going through as a country. So you cannot have a tunnel vision. You have to think long-term, buy in the whole long-term, which is not easy, right? I mean, you got to show discipline, commitment, and a focus to become a successful long-term real estate investor. So it's not for everybody because real estate will allow you to create generational wealth, but it's not easy. If it is easy, if real estate investing is easy, everybody would do it. Since very few people are able or willing to do it, so you are one of the few that can accomplish this goal. But you gotta have a long-term investment philosophy. So appreciation, equity growth, that's the name of the game, 5 to 7% annual appreciation over time. So it has been proven. And of course, no other asset class will afford you the ability to use the leverage, right? With your good credit, you can qualify to get financing. You can get a 30-year fixed rate mortgage, which is an amazing debt instrument. It's an inflation induced debt destruction. Another real estate expert use this term quite often, so it's a, a very intriguing terminology to say the least. So OPM, right? Other people's money. So if you're able to convince your bank or your mortgage lender because they trust you because you have good credit, you can get financing. You get 20 to 25% down payment, so you don't have to put all your money into to buy a property. You can only pay partially. You can only pay 20 to 25% of the value of the asset. Isn't it amazing? Your ability to get leverage, finance your way to wealth, and using the amazing debt which your renter is paying it down for you over time. Is that amazing? Your renter can make you rich. You're only at risk initially to buy each property, each your down payment. Now, if your projection of your cash flow plus appreciation plus tax benefit meet your expectation in about 3 to 5 years, all your down payment that you put up front is being paid for. Then afterwards, you're free. You're done, and you're done in a way that there is no more at risk because the property will run itself because you have to do nothing. Almost you're a part-time passive investor, whether you own 10 property or 20 property, as long as you find the right turnkey provider, as long as you find the right team in place in each market that can help you manage your property over time while you can relax and enjoy your life and maybe even quit your job. Not right now, okay? Later when your portfolio have reached its maximum optimization at some point in time in the future. Who knows when that's going to be, 7, 10, 15 years from now. Anyway, and the lasting message I have here is quoted by no other than the greatest legendary investor in the history of America, Mr. Warren Buffett. And he said, be fearful when others are greedy and be greedy when others are fearful. Because right now, there's a lot of people who are fearful out there, which is, to me personally, is unfounded. All these scary headlines is all over the place, but ignore them because you have to commit to your long-term goal. Focus on your personal economy. You cannot control what's happening with the mortgage rate, with the Federal Reserve, how they manipulate the housing market. You cannot control the economy, the job market, or the housing market. You control your own personal economy as long as you you work with the right team, you leverage, you have a team together in each of those markets. All the 6 or 7 properties I just illustrated you. If you have a right team that can help you, do all the work for you, you can buy remotely, buy passively, buy successfully over long time. So you could focus on the things that are important to you, like travel, retire, hang out with your children or grandchildren, do whatever you want, and you can dictate your life in your own terms. Your life, ultimately, when this portfolio will give you all the returns, the multi-dimensional returns you're getting, then you have a financial freedom. What does that mean? It means a whole bunch of things. You're not relying on your job. You're your own boss. Nobody can fire you because you're getting passive income. You're getting equity growth in your property. You're getting tax benefits. I mean, you could live the life with your own terms, do whatever you want, travel around the world, or cruising like I do quite a few times each year. Hang out with your grandchildren and spend time on kind of hobby that you like. So you don't, to a point where when your real estate portfolio are able to sustain your quality of your life, you don't need a paycheck. You don't need to work for others. You can dictate, you control your financial destiny. You create generational wealth for yourself, your children, your grandchildren, a generational transfer, impact the others out in your community, in your family, in your dynasty of your family unit. All right, so that's all I have to say. Thank you so much, and hopefully you receive a lot of value from this video presentation. If you have, please smash the like button and also subscribe to my channel and invite others into my channel. talk about people about me because I put out very accurate, very data-driven contents out there about all aspects of real estate, not just real estate investing. And I don't participate in the clickbait type of videos because I have ethics, I have morals. I cannot shame myself by showing the YouTube misleading, inaccurate YouTube headlines, negative headlines, just to bait you into a click to my channels to help the YouTube algorithm. That's not me. I cannot stoop myself this low compared to the other people who will sell their soul to the devil just to get the negative headline clickbait, which is a highly inaccurate, highly unethical, and highly not transparent, and it just hurt people. People need real data to make an informed decision, not misleading, inaccurate headlines just to scare people. The fear porn of real estate investing or real estate information out there in YouTube channel, which is a wild west of YouTube channels. So yeah, there's a lot of people are not very credible out there. So don't get mesmerized by those the doom and gloom negative headlines. The world's coming to an end, crashing, all those crash video, which is very misleading. Okay, so stay tuned for more great contents on a weekly basis. Thank you for attending. Oh, by the way, also please subscribe to my email, my website, so you can become a real estate member, free member of my real estate community with the Yee Real Estate Network. By subscribing to your email, you can get weekly real estate investing information into your email inbox, so you can take action to become a highly successful, potentially real estate investor and create the portfolio that I just shared with you. Thank you so much for your time. This is Seewing Yee. I will see you on the next video very shortly. Thank you so much. Bye-bye.